Have you ever wondered how to increase your stock portfolio returns? A strategy that often flies under the radar is the covered call strategy. This is a method favored by professional traders to generate additional income from their investments. But how does it work? Well, the covered call strategy involves two main components. First, you need to hold a long position in an asset. This simply means you own the asset, typically a stock. Then, here's where it gets interesting. You sell call options on that very same asset. This might sound a bit complex if you're new to options trading, but it's a strategy that can potentially boost your investment returns. Now, we've mentioned call options a couple of times here, and it's a fundamental part of the covered call strategy. Now, you might ask, what is a call option? Don't worry, we'll dive into that next. So, what is a call option? Simply put, it's a financial contract that gives the buyer the right, but not the obligation, to buy a stock at a specified price within a specific time period. This specified price is known as the strike price, and the predefined time period is known as the expiration date. Think of it like reserving a concert ticket. You pay a small fee to reserve the ticket at a specific price. If the concert becomes a sellout, you can buy the ticket at the reserved price, which is now cheaper than the market price. If the concert doesn't sell out, you can choose not to buy the ticket and only lose the reservation fee. In the case of call options, the reservation fee is the option premium, the concert ticket is the underlying stock, and the sellout scenario is the stock price going above the strike price. Now that we understand call options, let's see how they fit into the covered call strategy. Implementing a covered call strategy involves two steps: owning or buying shares of a stock, and then selling call options against those shares. Let's break down these steps. Firstly, you need to own shares of a stock. This could be a stock you've been holding for a while, or one you've just bought specifically for this strategy. Either way, you're now a proud owner of a piece of the company. The second step is where the real magic happens. You sell call options against the shares you own. These call options give the buyer the right, but not the obligation, to buy your shares at a specified price, known as the strike price, within a certain period of time. Now, these call options are termed as covered, because you, the seller, own the underlying stock. This is where the strategy gets its name, the covered call strategy. When you sell the call options, you receive something called a premium. This is essentially the price the buyer pays you for the possibility of buying your shares in the future. This premium is yours to keep, no matter what happens. So, if the stock price falls, the premium you received can offset potential losses. On the other hand, if the stock price rises, you might miss out on some potential gains, but you still get to keep the premium. In essence, the covered call strategy allows you to potentially generate additional income from the stocks you own by selling call options against them. So, we've seen how to set up a covered call strategy, but what are the benefits? The covered call strategy offers several benefits that can help boost your stock portfolio returns. First and foremost, it provides an avenue for generating additional income. When you sell a call option, the buyer pays you a premium. This premium is yours to keep, regardless of whether the option is exercised or not, providing a steady stream of income. The second major benefit is risk reduction. The premium received from selling the call option can offset potential losses in your stock position. If the stock's price drops, the loss is cushioned to the extent of the premium received. This makes covered calls a more conservative strategy compared to simply owning stocks, as it can help protect your portfolio during market downturns. Lastly, the covered call strategy can potentially enable you to sell your stocks at a higher price. If the stock's price rises above the strike price, the call option will likely be exercised, allowing you to sell your stock at the strike price plus the premium received. This can result in a higher effective selling price compared to selling the stock outright in the market. So there you have it, the covered call strategy, a powerful tool to increase your stock portfolio returns. Remember, every investment strategy comes with its risks, so always do your research and consider your financial goals before diving in. I hope you learned something from this video, and if you did, please smash the like button and subscribe to this channel. Until next time, happy investing.